The 712 portfolio is equally weighted diversification. Here we'll review its components, performance, and the best ETFs to use in its construction. The 712 portfolio is a lazy portfolio that aims to maximize diversification by utilizing 12 different funds, equally weighted, across 7 asset groups. Craig Israelsen designed the 712 portfolio. He is an executive in residence in the financial planning program at Utah Valley University. His most popular book is 712, a diversified investment portfolio with a plan. Israelsen maintains that the performance of a diversified portfolio is more important than the performance of any individual fund. I completely agree. This is basically the foundation of modern portfolio theory. Israelsen uses food analogies, suggesting that great salsa is all about diversification and that investment portfolios should include a wide variety of diverse ingredients. The 712 portfolio uses 12 funds, each comprising 1/12 or 8.3% of the portfolio across these 7 asset groups: US stocks, international stocks, REITs, resources/materials, US bonds, international bonds, and cash. I put groups in quotation marks because these assets only span 4 asset classes: stocks, bonds, real assets, and cash. By my calculation, the asset allocation comes out to roughly 59% stocks, 33% bonds, and 8% commodities. Specifically, the portfolio is constructed as follows: 8.3% US large cap stocks, 8.3% US mid-cap stocks, 8.3% US small-cap stocks, 8.3% ex-US developed markets, 8.3% emerging market stocks, 8.3% REITs, 8.3% natural resources, 8.3% commodities, 8.3% US bonds, 8.3% inflation-protected bonds or TIPS, 8.3% international bonds, and 8.3% cash. Here's the 712 portfolio's performance versus a classic 60/40 portfolio in the S&P 500 from 2003 through June 2023. Granted, this only goes back about 2 decades. Small caps and international stocks have suffered in recent years, and past performance doesn't indicate future results, but the S&P 500 and a 60/40 portfolio beat the 712 on both a general and risk-adjusted basis for this time period. The whole point of diversification is to reduce volatility and drawdowns and thereby improve risk-adjusted return. Notice that the 60/40 portfolio has a risk-adjusted return as measured by Sharpe about 1/3 higher than that of the 712 portfolio, and with significantly lower volatility and smaller max drawdown. Volatility and max drawdown of the 712 portfolio were actually not too far off from those of the S&P 500 index, which even delivered a higher risk-adjusted return despite greater volatility. Here are the rolling returns. Drawdowns over that time period are illustrated here. Notice how in some cases the drawdown of the 712 portfolio was actually greater than that of the 60/40 and the S&P 500. Being a boglehead myself, my knee-jerk reaction to the 712 portfolio is that it is somewhat antithetical to Jack Bogle's proposition of the majesty of simplicity. Obviously, one could construct a more complicated portfolio, but 12 different funds just seems unnecessarily complicated. In fairness, the portfolio is specifically overweighting segments like small caps, mid caps, and emerging markets relative to their market weights, so separate funds become necessary up to a point. The naive equal weighting seems arbitrary and is almost certainly suboptimal given the assets we're buying. I would submit that an allocation using risk parity, even if it's just a starting point or simply market cap weighting, would likely yield a more robust long-term portfolio. I'm all for not relying on overfitting or a mean variance optimization output to dictate allocations, but the equal weighting here seems more haphazard and less of a thoughtful plan that the book title suggests. In complete fairness to Israelsen, I haven't read the book. I'm generally not a big fan of commodities. They have largely fallen out of favor as their long-term returns have been dismal, which we would expect. We want diversifiers to have positive expected returns. Commodities have had negative real returns over the past century. I explained these details about commodities in a separate video here. The prescribed natural resources is something I've never actually encountered in a lazy portfolio. There are only several funds available for this asset category, all with relatively high fees. The heavy allocation to commodities and natural resources will likely just drag down returns over the long term. Funds for these assets also have much higher fees. At the end of the day though, these are just commodity producers, such as gold miners. These companies are more correlated with the stock market than with commodities themselves, which sort of defeats the intended purpose of their inclusion. In holding them, the investor is also taking on the business risks of these companies that may be unrelated to commodities. Lastly, commodity producers tend to sell commodity futures to hedge their price risk, which basically cancels out the precise hedge we're looking for. Similarly, with 16.6% in US and international bonds, bonds, I question the need for an additional 16.6% dedicated to cash and tips. These two, while providing a mild inflation hedge, are going to drag down long-term total return. That would be totally acceptable for the investor with a short time horizon or a significant aversion to risk, but then that investor should almost certainly be interested in a greater allocation to fixed income. In other words, the investor who would be interested in the sales pitch for this portfolio would want less stocks and more bonds. We also know that small cap growth stocks don't tend to pay a risk premium. Israelsen has written about the value premium in the past, so it seems strange that he didn't specifically target small cap value here over small cap blend. As is the case with some other portfolios I've discussed, if one knows about and believes in the size factor premium enough to overweight those stocks, they should also know about and believe in the value factor premium just as much, if not more. The tilt towards smaller stocks here also only applies to US stocks and not the international stocks. I also think the 712 portfolio looks more diversified than it really is. For example, we could achieve the same global equities diversification across all cap sizes and all markets with Vanguard's Total World Stock Market Fund VT, but here we're using 5 funds to replicate that exposure. Despite what many beginner investors think, simply buying more funds does not always mean greater diversification of the portfolio. While the 712 seems to be an interesting thought experiment and is certainly a very colorful, lazy portfolio, it's definitely not for me. It certainly doesn't match the needs of the young investor with a long time horizon for whom assets like cash, tips, and commodities make little sense. But then it also doesn't seem conservative enough for the retiree looking to get a similar risk profile to a classic 60-40 allocation. So it's hard to pinpoint the exact audience for whom this portfolio would be suitable. I'm always supportive of any portfolio that steers investors away from stock picking, but I see no compelling reason or research-based justification to adopt the 712 portfolio over, say, much simpler options like a 60-40 portfolio, a 3-fund portfolio, or other lazy portfolios, including other slice and dice ones, all of which should have the added benefit of lower fees. I would also argue the latter options are much easier for a DIY retail investor to understand due to their greater simplicity, which may allow the investor to stay the course more easily than with the more complex 712 portfolio. Tracking error regret, giving up on a strategy after consistent underperformance is a real concern, and simplicity in investing is vastly underappreciated. And there's the rub. The 712 portfolio seems better suited for a seasoned, semi-active investor who is going to take the time to research the potential merits of the assets and their allocations, not for an armchair retail investor who needs to simply take it at face value and trust in its ability to generate long-term returns and mitigate risk. Again, I would submit that a simpler portfolio would be easier for that investor to grasp and get behind without wavering. Ironically, those simpler options may also yield similar returns with lower risk, as we saw with the backtest earlier. Now we'll look at how to construct the 712 portfolio using ETFs. If you comb through the 712 portfolio website looking for specific funds to use in its implementation, you won't find them. Israelsen wants to charge you $350 for that information. Luckily, my suggestions are free. Using mostly low-cost Vanguard funds, we can construct the 712 portfolio like this: VOO at 8%, IJH at 8%, SPSM at 8%, VEA at 8%, VWO at 8%, FREL at 4%, VNQI at 4%, GNR at 8%, BCI at 8%, BND at 9%, SCHP at 9%, BNDX at 9%, and SGOV at 9%. I'll include a link in the description below to invest in this portfolio if you're interested. For a lazy portfolio that seems to do a better job at mitigating volatility and risk, I'd suggest considering Ray Dalio's famous all-weather portfolio. Click here to see my video on that. What do you think of the 712 portfolio? Let me know in the comments. Thanks for watching.